Ever felt like the stock market is a giant, unsolvable puzzle? Like only a select few truly understand its secrets? Well, what if I told you one of the sharpest minds cracking that code? Managing billions for Fidelity, started not on Wall Street, but with a passion for art history? Meet Denise Chisholm. She doesn't just look at charts. She sees patterns, narratives, and history repeating itself, just like in a timeless masterpiece. She trades a paintbrush for a portfolio using a unique blend of quantitative analysis and historical perspective to navigate the chaotic world of finance. How does an art historian become a titan of the stock market? Her story isn't just about money. It's about a revolutionary way of thinking that could change how you see your own investments. Stick around and let's uncover the secrets of one of finance's most unconventional geniuses. Don't forget to like and subscribe for more.
I mean, it's great because you have perspective from all of our diversified portfolio managers that come at it in different ways. I mean, we have so many seasoned investors who have been through so many cycles, and some people remember the nuances and some people remember the data. And it's interesting from my vantage point to look back at the data historically now within the rearview mirror, but to talk to people who actually lived through it at the time, even people that, we'll talk about the bear market of the 70s. We have people walking in the halls that know exactly what that bear market felt like.
That's such a great point. Michael and I are market historians, amateur market historians, but we do read and listen to everything we can get our hands on. Of course, we look at data, we look at charts, but that is not the same as talking to people who were professional investors during those moments and then maybe combining the two things.
That's exactly right. I mean, I think it provides, you get the perspective and the data. I think the data shows you when to not let emotion take over, but it's important to understand the nuances. If you lived through something, then you understand the nuances and the data that you should look at that perhaps you wouldn't have otherwise.
What's harder for people, living through a bull market or living through a bear market? And I don't mean harder financially. I mean, when you talk about controlling your emotions,
I would say bear market. I mean, I think statistically, when you look back, what's the retail investor's biggest problem is that they don't tend to get the returns that are on average the equity markets deliver because they are too busy selling at bottoms.
I think it's part of the same thing because it's bad behavior in the bull market that makes them do the opposite in a bear market.
That's fair. I mean, I always say stocks bottom on bad news. So if you use bad news to get out, when are you going to get back in? So the getting back in is problematic as well.
So we were talking before we started recording about historical data because that's like your whole jam and you look at a lot of it. But a lot of the nature of the data changes over time. First of all, we didn't have the data. So in the data from the 60s, it wasn't available in the 60s.
Right.
And so just having knowledge that the data exists changes the meaning of the data. And then of course, companies from the 50s and 60s and 70s look nothing like the companies today. So when you're looking at historical analogs and historical ratios and fundamentals and margins and all that sort of good stuff, how do you make it make sense and not get anchored to a world that doesn't exist anymore?
Because it's almost never an analog. It's really about finding patterns. And most of the time, especially in macroeconomic data that has existed for quite some time, it's about thinking through the things that you think are very significant. And oftentimes, when you actually go back in history and look at it, is more noise than signal. And at the very minimum, it tells you what not to bet on. I mean, it's usually one of those situations, what's the old quote, where it's not what you don't know that gets you in trouble, it's what you know for certain that just ain't so that's the problem. And I feel like the more I look at macroeconomic data, the more I see those patterns. I mean, uncertainty recently was a great example. Oh, there's very high levels of uncertainty. That's likely to weigh on corporate spending and therefore very likely to weigh on stock returns. The problem is not only can you not prove it in the data, there's the opposite correlation. The higher uncertainty is, the more likely the market is to go up in your face. Does that mean 100% of the time? No, but that's a pattern that persists historically, even though there's no analog, right? It was tariffs this time, which is not analogous to any other situation we've lived through. But that pattern is kind of like a red flag waving in your face.
It's totally counterintuitive, but I'm looking at how excited you get by that. Is that the best thing as somebody that's looking at data to see, I don't know, watch me on TV say something and all these other people repeating the same thing over and over again. And then you go back and look in the data and it's like, they're all saying the same thing, and none of them are right. Here's what actually happens. Is that the thing that you get excited about?
It's definitely what I get excited about, which is not to say that I know whether people are right or wrong, but it is to say that there is a dangerous presumption that we make all the time with market narratives that more often than not, to your point, are not true.
Well, here's one.
Yeah.
Speaking of tariffs.
Yes.
We were told with extreme certainty by many people, whether they're at hedge funds or institutional asset managers or traders, we were told repeatedly that Trump's tariffs, given the nature of how they were rolled out and how messy all the commentary around them was going to have this effect where people from around the world were going to begin gradually withdrawing money from the US dollar, from the US bond market, from the corporate bond market. They were going to pull money out of stocks. In fact, in all cases, it was the complete opposite. Maybe not the dollar. But when you looked at inflows 6 months after Liberation Day, and you look at what went on, the international community of investors bought as much stock as they possibly could, breaking records in some cases. They bought US bonds, they bought corporate bonds. I don't know what the message of that is, but it is the exact opposite of what the prevailing wisdom was just after that tariff announcement was made and the way it was executed. Was that the kind of thing that you looked at and said, I'm not so sure about this story of the outflows from U.S. investment markets?
I mean, it's interesting when you think about it. I think the quote that resonates the most is, the stock market has discounted 9 of the last 4 recessions, right?
Yeah.
So the stock market reacts very quickly. But when you go through the math, and you can look at this in history, I mean, I always say that the bar is high. Recessions are rare. It takes quite a shock to tip the U.S. economy into recession.
Well, that one looked like it would have qualified.
No,
on the surface?
I think when you go through the math, I think I had a hard time getting there. So when you look at the math historically, now I would say that when I look at the cycles, it takes something between 2.5% and 3.5% of a hit to U.S. income to tip the U.S. consumer into recession. I mean, the financial crisis is an interesting example and sort of how time and price can actually converge. So crude oil prices were between 18 and 22 forever for when we were growing up. And then they were 50 and then they were 70. And we were like, why isn't the consumer having a problem with this? And then they went from 70 to 150. That shock was enough to tip the US consumer to negative consumption. And that, on top of the leverage that we obviously saw, that was the tipping point that basically started the recession that obviously compounded it in 2008. So it's an interesting thing to think that all recessions were met by shocks that were pretty sizable. And you can usually look at oil prices and the Fed to see where those shocks came from. You can do the same math behind tariffs.
Okay.
So tariffs, we thought—
Substitute oil for tax on trade.
Correct. It's exactly what it is, right? We're guessing where the tax ends up. So, you have to make some guesses, but we can say $3.2 trillion of imports. We landed on 15%. Half ends up in the U.S. consumer's lap. None is absorbed by currency. None is absorbed by the foreign producer. The other half ends up in corporate America. What is that as a shock? That's about $250 billion on $25 trillion of income. That's a 1% headwind to the U.S. consumer. That has not been enough historically to tip us into recession. Because we have had 1% tax hikes historically that haven't been enough. And the reason why is not that 1% is not meaningful. It absolutely is. It's just you're so focused on that headline risk of the headwind, you don't notice other things like the tailwinds from oil prices going lower this time that almost completely offset that $250 billion. So you end up going through the math and saying, yes, it's different, but it's still a shock. It's still a tax. Is it enough? And you come to the conclusion of maybe not. And in that instantaneous almost bear market, the stock market did discount a recession. Yeah, let's go back to the nuances of the data was really around the historical instances of corporate tax cuts. And while we didn't have a change in the statutory rate, we have a pretty big cut in the effective rate for corporate America. So it was looking through history and saying, okay, if history is some sort of guide as to what this big, beautiful bill act can actually do, let's look at the times that we've cut taxes before. Does it mean earnings will grow? Does it mean GDP accelerates? And what you find is what it usually means first is CEO confidence bounces. The second order effect, the year following, is GDP and earnings. The interesting part about that is, and you say, okay, it is a little different this time because CEO confidence was at recessionary levels without being in a recession.
When? Last year?
Just
or early this year?
Early this year.
At recession
At
levels.
recessionary levels.
Okay.
So by recessionary, I mean like bottom decile.
But don't you think it made
Which is-
sense? Because
of
they had no
course.
idea what their inputs were going to cost. They were flying blind.
Absolutely. I don't think yes, let's take it for what it's worth, right? So I'm not saying that it's worse this time or better this time. The data is the data. And you can see, and from a historical perspective, is that bad for stocks? No, that's exactly the setup you want. You want CEO confidence to be bottom quartile and rising. And that's exactly the signal that we're seeing, because what does that usually lead to? It means that earnings growth is more visible historically to CEOs. And because of that, you get multiple expansion before you ever see the earnings growth.
Have we had it though?
Multiple expansion?
Yeah.
Yes, but so certainly we're close back to, on forward PEs, close back to all-time highs. But I think that when you look back historically is that it's not very clear where multiples need to be capped. When you think statistically, does it mean what we think it means? You should see some sort of pattern between the more expensive stocks get and the lower future returns are over the next 1 or 3 years, and you don't. So when I look at valuation data, for me, again, just as a quant, like forget the meanings that we think that they have. To me, it just means confidence. The more visible earnings are, and earnings are getting more visible because we've seen CEO confidence bounce, because we've had this legislative activity, because now the Fed is on our side, the more visible earnings get, the more likely multiples are to go higher with no cap. So for me, I think
Why do
valuation
multiples go higher? Because Wall Street feels more confident when there's visibility.
Yes. And I think in some ways you can think about it as there's a R star for the Fed is there's some sort of mid-cycle earnings, right? So in PEs for any one period of time is probably not accurate. Really what you want to know as an investor of what are mid-cycle earnings and then what multiple should I put on it? And for me, the way I sort of piece together the story is the more expensive stocks are, all they're really saying is, be careful, investors, mid-cycle earnings are higher than you think, which means at some point we will look back at this and say stocks were cheaper than we thought.
So looking back, do you think that we're going to look back and say that the Fed made a mistake cutting rates, given that, so they were responding to weakness in the labor market primarily, but now we're seeing Atlanta Fed GDP saying we're going to be at a 3.9% annualized rate for growth in the economy. Spending is still solid. We had upward revisions. And we've got this hyperscaler spending boom.
Yeah.
Is now the right time to be cutting rates?
So there are two things. One, level, and then two, let's talk about the growth rate for a second. On an annualized basis, you're absolutely right, quarter to quarter, but on a year-on-year basis, GDP has grown around 2%. What we talked about, historically back since the 90s when we were investors was that 2% was that tipping point, meaning that the US economy is growing, what I would say quite slow relative to history. Or I wouldn't say that it is quite nearly as dynamic as that 4% sequential growth implies. And the level of real interest rates should have some proportionality to what you think that underlying growth rate is. So we do have to struggle with what that underlying growth rate is. But when you look historically, if inflation comes in lower than we expect, and that's kind of my base case, because to me, tariffs are more deflationary than inflationary, then it means that the Fed—
Why do you think that?
Because I think that they act like a tax. So yes, the prices of some goods go up, but unless somebody gives you more money, your marginal propensity to consume, if you had to buy that tariffed washing machine, goes down. So somewhere
They're
else—
demand killers.
That's exactly right. And if you think about the underlying rate of inflation, to me, it's quite slow. So core CPI ex shelter, which we can debate if shelter's the right sort of calculation from a Fed perspective, but I think you can make a really strong argument that it's driven by a supply shock by the initial Fed hike. So if we think about sort of core ex shelter, that run rate was around 2%. So we don't really have a broad-based inflation problem, and the tariffs, even the goods we're seeing, are off of this decelerating base. So it may very well be the situation that it's not a mistake because the underlying run rate of inflation, and oh, by the way, GDP growth, is such that the Fed can pivot and can renormalize monetary policy from a situation which was too tight this time. I mean, because it was very unique where retail, I think as a group, didn't sell in a what I would call almost bear market. Now, I will say—
Pessimists would say they didn't have time to sell.
That's exactly what I was going to
Okay.
say. That's
All right.
the other side of the coin. And I do think that there is, and I think you're right in that the financial news has gotten to people by, sometimes when the market moves very fast, it's too late. to be bearish, or
no time to panic.
Right. You
anymore.
are paid not to react very often, right? And there is a relationship that I actually wrote about in that bear market, or the quasi-bear market, which is there's a very strong statistical relationship between the speed of the bear market decline and the odds and magnitude the S&P is up on the other side. So that was the unique, like we always talk about being afraid of those three big secular bear markets, the mid-70s, the dot-com, and then the GFC. And those were really defined by taking 300 days to get to bear market territory. When the market discounts bad news very, very quickly, and ours was the third speediest in history, then you're almost paid to hold your nose, close your eyes, and just wait a year.
Who was just telling us about how V-shaped recoveries are actually the norm?
Chart Kid.
That was Chart Kid.
Well, he has a chart on it. So I'm curious, looking back at history, all of those bear markets that you mentioned, it took time to digest and to price in the worst.
Well, things got worse as they went on.
Things did get worse.
Right.
I hesitate to say that can't happen again, because I feel like of course it can. But doesn't it feel like when the news hits, it just happens so quickly?
Yes, well, it certainly did this time statistically.
Those have to be outliers, though. That's not a business cycle bear market, obviously. Well,
right, but I think that's well said in terms of COVID was very different, and I think we have a knee-jerk reaction as to thinking COVID and the financial crisis were these two almost lights out moments where you really have the U.S. economy collapse quickly for different reasons. But that's not historically the norm. Very outliers. So I think that in some ways, even professional investors, that knee-jerk reaction is to sort of play what you know, which is the last cycle, which was a light. That's why I think patterns in history can really help, right? It is always different this time. There is nothing the same. 2020 was very different than the financial crisis, which was different than the dot-com bust, which was different than the 1990 recession that I sort of first experienced as a college graduate. So they're all different. For me, what is, I think, interesting is that the patterns remain the same.
Of buyers and sellers.
Yes, buyers and sellers, and exactly. And the longer your time horizon, right? So sometimes I can't tell you what's going to happen, or obviously I can't tell you, but the data can't tell you with perfect foresight what's going to happen in 3 months or 6 months. But as soon as you start being willing to extend your time horizon to 12 to 18 months, all of a sudden you can start to see these patterns and say, well, if I have that kind of view, or if I have that duration, then all of a sudden I can look through this volatility to make money, right?
Is this like one of the legs to the stool for how this bull market can continue into 26?
Well, it definitely is. I mean, the interest rate sensitives as an asset class, but let's talk about home builders specifically, have largely been left behind. I mean, they're the same multiples they always were at the trough,
they're
but
tiny
relative.
Too in market cap.
They are tiny. But even if you add up all the interest rate sensitives, they're all very similar in terms of relative valuation is what I would call statistically cheap, meaning it's bottom quartile.
Relative to itself?
Right. So relative to the S&P, relative to its own history back to the 60s. So the interesting part about, you quoted the GDP of 3.9%. Housing is in recession, right? Residential investment is contracting, right? This is not a dynamic U.S. economy. And it's been a rolling recession. We're not at the troughs that we were in 2022, but we're not far removed from being, that bad as well. And again, the stocks have been still statistically cheap. Now, what was different this time than the last time the Federal Reserve was cutting is that the last time the Federal Reserve was cutting, we saw very little translation to mortgage rates, or even to the 10-year Treasury for that matter, partly because overall inflation or core inflation was above median levels. The irony is this time that they're cutting, core inflation on a median basis is actually now below those levels historically, despite tariffs. So you see that when you look through history and you say, okay, when the Fed's cutting interest rates, what percent of the time do long yields drop? It's about 70. So it's not 100% of the time. But when you're at that below average level in terms of core inflation, all of a sudden it's 85. So you do see a statistical boost, and the only 15% that where you didn't see that translation was basically 95, 96, 98, 99, and 03, 04, where you saw this big inflection to 4.5% GDP growth. I don't think we're going to get there. So that leads to the transmission mechanism being much better this time around than a year ago. Now you couple this out with the starting point on relative valuation, which is advantageous for the stocks historically. So if we say this quartile, I see this nice monotonic distribution, which is I have higher odds of builders' outperformance when they have been cheaper. So, which is kind of a statistical way of saying, hey, these stocks price in bad news in advance. right? So you get 64% odds when they're this cheap. When you have long rates come down, all of a sudden it's 75, and X the financial crisis, which maybe you say this is nothing like the financial crisis, you're close to 90% odds. So that's a viable risk reward, right? You've got really strong odds and you've got really strong outperformance. Your downside is the fact that, to your point, affordability is likely solved by housing prices either being flat or potentially going down.
Not rallying.
Correct.
Right.
Now, the interesting part is you could say, okay, what's my downside to home builder stocks historically if home prices fall? And there is downside in every vertical of valuation, but it's minimal when your starting point is cheap. It's about 300 basis points. What's your upside in terms of that starting point on valuation? If you get this transmission mechanism from 10-year all the way to mortgage rates, it's about 35%, which is the math that I look at in terms of risk reward, right? There are no guarantees. Cheap stocks could be cheap for a reason. But if I think about the catalyst that could provide more underperformance, if I look at history and say, has valuation been able to price bad news in advance? If it's not as bad as the stocks have already priced, what's my upside? You're talking about a 10-to-1 ratio. So I'm with you. I think that there's opportunities in interest rate sensitive stocks, specifically in housing. Yeah. No, so when I look, the hurdle rate, when you look back in history on a rolling 1-year basis since 1962, the S&P goes up 75% of the time. So for me, as a data person that's coming in saying, okay, my hurdle is pretty high. What does that bearish precondition
Hurdle
look
to find
like?
something wrong.
Yes,
Yeah.
exactly. So my going in position any given year is, I think I'm a buyer. I need to argue with myself from a data perspective, why not? And the three things that I've looked at statistically that I think give concern is around things being too good, which we've been talking about. Like euphoria is the enemy of markets, of bull markets, right? You usually see that statistically at top quartile or top decile earnings growth of like 25 to 30%. We're grinding it out at 10 on a cap weighted basis, and median earnings has gone nowhere in 3 years, right? That's far from euphoric, meaning that the more sort of muted it is, the longer it can continue. So it could be durable. But that's, data point number one that I watch. Data point number two is in the high yield market, right? So the credit market usually is the smarter market.
It's asleep.
It's asleep, but it's not nearly as tight. So we have the data going back to the 80s. Now, you can sort of argue whether it's synthetic data, but the credit market has been way tighter. The tights that we're seeing right now don't statistically say, okay, that's a negative risk.
When you say tight, you mean like of credit availability or spreads?
No, spreads.
Okay.
So high yield versus the risk-free rate.
But isn't that good?
Yeah. So it is, but there is a point where it gets too good, right? So my indicators
Why?
for
Because
being a
investors are
seller,
being complacent?
Correct.
Anyone can raise
Correct.
money, and all of a sudden, people are taking too much risk.
Right. Just like when the
Minsky
news is
moment
bad
in
creates a
credit.
buying opportunity because it's all priced in. Sometimes when the news is good, that creates a selling opportunity because it's all priced in. Those factors have to come together statistically. And I just think that we're a long way from there, partly because I kind of think of 2022 as a landing. So I think it was either a very hard soft landing.
The fastest interest rate hiking cycle since the 70s.
Yeah, inflation, which is related to
Inflation,
rates.
okay.
But when you look statistically,
Inflation caused that bear market.
inflation above 4.5%, which is the break point for the top quartile, and rising is the worst setup for the market historically. The irony is above 4.5% and falling is the best setup for the market historically. So you need to be able to pivot and understand that high prices are the cure for high prices, which was sort of the Venus of that shape.
About this, but why that obsession with this is going to end, this is going to end, this is going to end?
I don't think it's ever different from history. I think that there's always a group that's going to be obsessed with that ending. And it's probably around the fact that there's always something wrong, right? It is always different this time. And there's always something that you can point to be the problem indicator. That's sort of when I look at the historical data, I think that that's where it can help you, saying, okay, if you're right this time and this is what's different. Payroll revisions, uncertainty. Let's see if that's predictive. Let's see if I would bet on that as a statistician or look at that as an indicator and say, yes, I want to trim my equity exposure. And to the extent that you can't look at those patterns and see a negative risk reward or see some sort of pattern, then I think you have to step back and say, yes, there are all kinds of things that are wrong. And yes, there are all kinds of things that are different, but do I want to give up my 8% returns to get that right? I mean, you can be right and still not make money.
So if the S&P were to get cut in half from today, it would take us back to the lows in 2022.
Ironic,
Isn't that
right?
kind of wild?
Yeah, that is.
And think
I
about
know.
from 2022, from 15 to 22, how long people were saying, this is going to end badly, this is going to end badly.
Yep. Well, it's, in some ways, when you think back to the 70s and 80s, the ultimate low of the bear market, when I usually give people the option, like between
What do you give for the ultimate low?
So between 1976 and 1985, for me, when I look at the charts, I think it's observable, the low was 1978. The low in 1980, obviously we corrected during that recession, was higher than the low in 1978. And the low in 1982 was higher than the low in 1980, right? So you could enter, like when Volcker came in and said, hey, I'm going to create a recession.
The low in 82 was the last of the lows.
Was higher than the two lows before it.
But nobody uses 82 as the low.
Right.
People use 75.
Yes, true. Which
is kind of odd.
Yes. But my point is, like in the mid-70s, if you sort of started and somebody would have came to you and said, hey, wait a minute, I think we're going to have 2 back-to-back recessions. Never happened in U.S. history before. And I think the second recession is going to be the longest and deepest since the Great Depression. You made money through that 5 years.
Right?
Yeah.
A little bit.
I don't know.
So when I look again, back to the statistics, right? So we had 2 instances out of 2022 and just recently where the S&P was up 25% over the course of, I think, 13 or 15 weeks, right? When you look at that historically, you say, okay, wait a minute, yes. And not just bullish, monotonically bullish, meaning that the more the S&P advances, the more likely the S&P is to advance.
You bomb atomically?
Monotonically.
I love that data too, because that can only happen in one scenario where everybody's bearish and wrong, and everybody has to reverse course and get back in because the bad news didn't come to fruition. So that sort of historical patterns always persist.
Right. And it looks like statistically a catch-up trade, right? Meaning that you already delivered the below average returns, you're sort of cherry picking your data, and then you have that catch-up trade. So I just think I'm cautious in saying that price creates a negative risk reward, because when you see that pattern historically, momentum usually begets momentum.
That could change the outlook.
I'm not even going to guess. I'm not going to guess because, and people do ask me, whenever I present to clients, they're like, what keeps you up at night? What are you worried about?
We'll turn the cameras off.
What are you worried about? And I say there are smarter people than me that know. I do try to focus really hard on what I think the market is already discounting. So that's where, like, whatever shock that you think you're hit with, tariffs, right, uncertainty, what will be the tipping point, or will the market be able to climb the wall of worry? So where are those statistics is what I focus on, meaning that if there is a lot of statistical fear in stocks, and you can think about this from a VIX perspective, you can also think about this to get pretty quanty from a valuation spread perspective. When there is a big gap in valuation spreads, and we're seeing this certainly on a median basis in the S&P 500, when there's a lot of fear in the equity market and there's not a lot of fear in the credit market, then you have, again, that sort of linear relationship. The more likely whatever you're worried about going bump in the night, the market can climb that wall of worry. We saw the opposite. The credit market was saying, hey, credit spreads are rising. We think that there's, solvency issues going back. And the equity market was saying, there's no problem here, right? VIX was very low, but more importantly, valuation spreads were very low. What are you talking about? Is that the GFC you're talking about, or something else? Going into the financial crisis and also going into the dot-com bubble, the credit market was saying, hey, there are companies going bankrupt. This is going to be a problem for the cycle. We're just not in that situation.